LLC.
Yeah.
Here's your control.
Yeah.
And I'll,
Control where?
it should be just.
Darwin, do you care that there is an
There
echo?
we go. Okay. Yep. All right. We're in.
Not.
All right, guys. So sorry for the delay. That's Kevin and me both. Look, I wasn't really prepared anyway. So, but Kevin Whitlock is with us here. Kevin is with Tedder Whitlock Consulting and Certified Public Accountants. So, we should no longer be getting that echo. Fingers crossed. All right. So, Kevin, I'm just because it's all yours. I want to sit back
All
and
right, let's sit back.
hang out here.
I stopped at the salon before I got here. I was down the street, so I've made it here. Anyway, good afternoon, everybody out there. And I'm happy to be here, happy to be with everybody. I'm Kevin Whitlock from Tedder Whitlock Consulting. We do tax returns and tax planning for business and individuals. And we work a lot with real estate professionals. And I want to talk about you as being a sole proprietor, sole practitioner, single member LLC. I've got a little PowerPoint that'll talk about a few things, and I've got some other things to talk about from our book for self-employed. Talk about that. So anyway, let's go ahead and start. So our office is located in Livonia. This is what the threshold of our office looks like. Our name's on the door. My name's on the door too. There's our conference room. There's people in our conference room. We're a conference room in action. There is the majority of our staff. There's 8 of us there. We have 12 in total. There's 4 new hires that we haven't taken a new picture on. So that's who we have on staff right now, and plus 4 that we have in addition. So our team, there's myself, my wife, Patrick, Paul, Kathy Folis, Carrie Brown, Jessica, Laura, Rana, and Michael. All of our staff are on here. Maggie, Betsy, and Melissa. They're our administrative assistants. And so we're a full service certified public accounting firm. We do tax accounting, auditing, and consulting. We're based in Livonia. We work with individuals and companies all throughout the Tri-County area. We have some large clients that have business all throughout the USA, and we can help with whatever you might need in that regard. Let's see what we do. Tax prep, bookkeeping, certified financial statements, estate and trust, nonprofit. I also work with individuals that maybe haven't gotten their tax returns done in a timely fashion.
That doesn't happen in real estate.
I'm working with a couple people right now that I'm working on preparing 5-6 years worth of tax returns in one block for them to get them caught up and get them what the IRS calls in compliance. So people like to be in compliance. It doesn't run on your brain that way and pull you down. So that's a good thing to have everything squared away. Okay, so let's talk about let's not look at the screen right now, what I have up on the screen. Let's talk about you and things that you talk about from this book. Okay.
And Kevin, for those that are out in our, what are we, 17, 18 offices that might be watching on Zoom.
Okay.
Is there a way that we can get them these books that you're showing?
You can. I've got stacks of books here that I'll leave behind, or I can always mail out from my office. Either way, I can leave behind for here or whatever it might be.
Sounds good. So managers will work on how to be able to get these books to them.
Yeah, right. That'd be great. Yep. Okay. So as individuals and sole proprietors, whether you're a single member LLC or you're just a sole proprietor, the main thing that you want to look at is keeping good records. You're going to, your income is going to come from your broker on your 1099. You might have a little miscellaneous income here and there, but the main part of your income is going to come from your 1099 or 1099s from your broker. The income is pretty simple and pretty easy. The hard part is keeping track of all of your expenses throughout the year. That's the thing that makes your job difficult and makes my job difficult, because if you don't have them organized in a fashion that I can use them, that makes it more difficult for me to prepare a tax return that can give you the benefit of all the tax deductions that you might have. So a lot of individuals like to pay with cash, and I ask that you don't pay with cash. because if you pay with cash and you use receipts, then the receipts get lost. The easiest way to keep track of your expenses is either to use a check from a checking account, or B, to charge your expenses on a credit card. So that way you've got a record either through the bank or through your credit card of your expenses that you're going to have that you're spending throughout the year. So that's the biggest thing that you need to do. Probably from there, I would look at something along the line of, okay, we got the ECHO taken care of, PDF. I do, yes, I can send I can send you an email on the PDF. Yes, I can. Okay, so let's talk about some expenses that you may or may not have, or some things that you as an individual would have, that's a real estate professional. So from a real estate professional standpoint, in the back of this book, we have an Excel spreadsheet, a spreadsheet that we've developed for real estate professionals. And some of the expenses that you would have, and if you don't, you might look and check and see, because you probably should have. You've got advertising, you've got your vehicle expense, you've got computer expenses, you got your MLS fees, etc. You've got fees for your tax preparation, hopefully, professional tax prep. Let's see, subcontractors, if you are paying, so that's something, if you are paying to have an assistant, and you're paying that assistant more than $600, you need to issue them a 1099. That's important. IRS is looking for 1099s. If you're paying anyone to assist you, or anyone that's doing some subcontract work for you, if you're paying them more than $600, you need to give them a 1099 at the end of the year.
So an independent contractor can actually go ahead and issue a 1099. They do that on their own?
Yes, they do. What you need to do is you need to prepare a 1096 form along with a 1099, and then those go off to the Internal Revenue Service.
But of course, if
you need
they're
help
working with
that,
you,
right,
that's just part of the service.
that's right. If you need help with that, we can take care of preparing 1099s for you. So that's pretty simple. Or
You
at
know,
least it can be simple.
Now, this is one that's come up in the past, and maybe you would cover this. But if I'm going to put more money in my pocket, is there something I can do with my children to?
Yep. Yes, there is. So one of the things, and that's one of the topics that are talked about in the book, is if you hire your children, you can pay your children. And what happens then is there's a double benefit from paying your children. A, if they're under 17 and you're a sole proprietor or a single member LLC, then there is no Social Security and Medicare tax that's paid on those wages to them.
Wow.
So you get to skirt the 15.3% Medicare and Social Security as long as they're under 17 and you have a single member LLC. The other part of that is, as the expense that you have in deducting them as a subcontractor, or well, in this case, an employee, every individual has a standard deduction, and that standard deduction is roughly $13,000. So if you pay your child $13,000, there's no federal income tax on that.
Wow.
So you're getting a deduction on your Schedule C for 13 grand if you paid your child. They're putting that $13,000 on their 1040, their individual return. And because there's a standard deduction, that standard deduction wipes out that whole $13,000 of income. So there's no income tax on that. Now, you'll have to pay state income tax on it because the state's not as generous as the feds are. But that's a benefit that you would have.
I think I could live with that. So
you're saving 15.3% for starters, and then you're saving whatever your individual tax bracket is, which might be 22%, 24%. Plus, you're not paying the 15.3% on it that you pay in Social Security and Medicare tax. So you're
per
saving
child,
a bunch, right?
if I could do this.
Yeah.
So
the children have to be able to perform the task. They can't be 5, they can't be 4. They probably need to be somewhere around 13 or 12 or 14, somewhere in the ballpark where they might be able to address envelopes or empty baskets or sweep the office.
yeah, I mean, I've got she's 9, going to be 10-year-old granddaughter who does my mailers.
Okay, there you go. Right.
So,
yep.
Interesting.
That would work very well. So,
So does that apply to grandchildren then?
that's a great question. I can't answer that right off the top of my
Okay.
head.
All right.
I'd have to look. I don't think so, but
That would be my guess. It's not, but what the heck? I got to ask.
it's worth a shot. All right. Okay. The other thing that I would talk about is if you have a Schedule C, which you will, and you have a profit, at some point in time, I'm thinking that you probably would like to retire. You'd probably like to sell your real estate business that you've developed. You'd like to pass it on to someone else, maybe have some income from that. But you'd also, before you get to that point, you want to put some money away in a retirement account. So putting money away into a retirement account, that will also reduce your income tax cost. Okay.
Right.
So putting your money away in a SEP plan, in an IRA, in a solo K, one of those three vehicles will save you income tax, and you can pay it down the road when you're in a less earning bracket, and you're going to pay less tax down the road.
And it's an interesting part because, you know, we talk about, we've got a tool called the goal projector.
That's right.
In both our blue and gold, which determines how much money they need to make. And part of that is addressing savings. So they could easily say that, well, what's the cap on an IRA per year?
IRA cap on an IRA, if you're over 50, is $7,500.
So they could simply put in $7,500 in there. They meet their goal. They've just saved themselves a lot of money in multiple directions. So I like that.
So IRA is real simple, or a SEP plan, or a solo K. If you're a high income agent, I would suggest a solo K, which is a 401k solo, which is, if you're a sole proprietor, you're a solo owner, that works really well for a single member LLC.
Okay.
And if you're not a high income earner but still want to put more away than $7,500 in an IRA, a SEP plan would be the vehicle to do that.
When it just hit me with the aspect of you saying solo. So I'm 1099, but I have a spouse that has we'll say a good income, and they're a W-2 employee. Does that make any difference on how we might file things?
No, it doesn't. No, you'd want to file married joint, and whatever your spouse is doing, and they're an employee, and they hopefully have a 401k plan with wherever they're employed at, they can put money away in their retirement plan, and the SEP plan or the solo K allows you to put money away into your retirement plan on your own.
Okay. All right.
All right.
Good deal.
Okay. All right. Now, for those of you out there, and I know if you've been in one of my seminars in the past, we've talked about auto expenses, we've talked about cell phone expenses, we've talked about home office. I still get questions about home office.
Yeah.
And people say, is home office really worthwhile? And does the IRS look at it? And again, in the 80s, they used to look at home office a lot. They used to look at it with a microscope. But as we all know, and as you out there in Zoom land or whatever it is that you're at, if you're working from home, things have changed from 1985 to 2020 to 2023 as far as people working from home, people not working in an office. And the IRS realizes that, and they have geared their looking at tax returns and how they deal with tax returns and sole proprietor Schedule Cs to people that have a home office. Okay, so home office used to be, you would take actual expenses and you'd take your insurance and your mortgage interest and your property taxes and multiply them by your percentage of the home office is to your total home square feet, and that would get you a deduction. 7 years ago, I just read this the other day, 7 years ago, the IRS came out with a home office standard deduction. So if you're familiar with auto expenses, you've got an actual write-off of expenses and you have a standard mileage rate for auto. You have actual home office expenses, and then a standard deduction when you're looking at home office. So that gives you a little inkling about what the IRS has done in looking at
major change
at home office. Right, home office expenses, correct.
Wow.
And deducting home office.
So obviously then where that used to be a red flag for, maybe an audit, it's no longer as,
Not at all.
and we should all be having it.
You definitely better. If you're a real estate professional and you're not doing a home office, then that means that you're not spending any time at home. You don't have a dedicated room. Now you have to have a dedicated spot that would be just for your office. I had a situation at one point where a woman that worked as a subcontractor had a 1-bedroom apartment. She couldn't do home office because she had her bedroom was her bedroom, and she had a living room and a kitchen in her apartment, but those were living room and kitchen. They couldn't be a dedicated office. So you have to at least have a 2-bedroom apartment or a 2-bedroom home in order to do a home office.
So it's got to be a separate room.
It's got to be a whole separate room.
No.
The standard deduction, it's anywhere from $500 to $2,000. It's not as much as if you had the actual, which is very similar to the auto expense. I mean, actual expenses will sometimes get you a little more deduction versus the standard mileage rate. And if you do the home office with the actual expenses, it'll get you a little more deduction than it will if you do the standard. However, if you do the actual expenses for your home office, when you sell your house, and because you're depreciating part of that house as your home office expense, when you sell that house, that little bit of depreciation that you've written off, you've got to pick back up and pay tax on. Okay. So normally, we'll go back. Normally, one of the things I would talk about, normally you have your home and you sell your home. And if you've held it for at least 2 out of 5 years, there's a $250,000 exclusion for single filers or a $500,000 exclusion on your gain when you sell your home. So if you sell a house and your gain is $400,000 and you're married filing a joint return, there's no income tax to pay on the sale of your home, unless it's been a home office. And let's say you deducted depreciation for 5 years and you deducted $1,000 a year. So you've got $5,000 of gain you're going to pay tax on at 15%. Not a big number,
Right.
Not a lot, but just something to be aware of on the actual home office expenses versus the standard.
Wow.
Okay.
Now that brings up probably a fairly simplistic question. Where can I begin claiming mileage from?
Excuse me. Okay.
And I hope everybody understands, because does it start at the house? How's it really work? Where can I start to actually say, this is a deduction for the mileage I'm driving today?
Okay. So if you have a home office, that's your office. I don't have a home office. I drive from Highland to Livonia every day. So my mileage from Highland to Livonia and from Livonia to Highland is non-deductible. It's a personal expense. But if I have a home office and I'm working out of that home office, whenever I go from my home office to wherever it is I'm showing a house or meeting a client, meeting a customer, that's all going to be deductible business mileage.
What about from then my home office to our physical office where our license is at?
I would also include that.
Okay.
Yeah, I would because again, it's your home office. You're working out of your home office. Okay.
Wow.
Yeah. Now again, from an auto expense perspective, the IRS knows that everybody likes to embellish your mileage. And if they want to come and look at your tax return, they're probably going to want to see an auto mileage log. Not many people keep an auto mileage log, but an auto mileage log is helpful and it's something that they're going to want. I tell clients, at the end of every year, sometime in December or in early January, take a look at your odometer every year. So then you have a beginning mileage and an ending mileage to know your total miles for the year, because the IRS wants to know how many miles you've driven for the year. And then they also want to know how many miles were business miles. Okay.
So I use, and we recommend to a lot of people, there's different mileage trackers.
Yep.
But I always recommend Mile IQ. It prints out, I started here, I stopped here, the day, the time, and if we're using, say, a digital calendar like Google, those two match up, that would survive the test for the IRS should I ever be audited.
Correct.
Those two line up.
Yep.
Therefore, I'm justified on my mileage because it also explains essentially where I was and what it was for.
Correct. Yeah. Yeah. You want to have, and again, Mile IQ, as Darwin was saying, Mile IQ was a great tool to use to keep track of your mileage.
Mm-hmm.
And that works really well. But you need to have total miles, business miles, and then where you've been. You know, I went to see Kevin at his office to get my taxes done, or I went out to see a customer in Rochester Hills, or I went out to see a new client down in Clawson or wherever it might be. So the Mile IQ and the Google will give you where you've been, who you've seen, and that's what the IRS needs to know. Okay. Home office. Oh, okay. I got a question. Please confirm you do not pay capital gains taxes if using this standard deduction for home office, and that would be correct. You only have to pay cap gains on a personal residence. If you have a gain, again, it's if you have a gain on your personal residence, you only have to pay tax on that gain when you depreciate your house using the actual home office expense deduction. If you use the standard, then there's no depreciation that you have to pick back up on your tax return when your house would be sold. Okay? All right. Hope we got
Good
that
deal.
answered.
Yeah.
All right.
I don't think I've got anything else, so we're probably ready for wherever you do have planned.
All right. So again, we'll go back to, we talked about vehicle. We talked about keeping track of your mileage. We talked about actual expenses versus a standard deduction. Let's see. You got a mileage rate versus all your expenses you got to keep track of. So a lot of people use the standard mileage rate just for deducting auto expenses because it is so much easier. I just need to know my total miles for the year, my business miles times the standard rate, which was 68.5 cents a mile in 2023. Okay. And that's it for mileage. Home office, we talked about again, standard write-off of home office with insurance and mortgage interest and property taxes, repairs and maintenance, and actually depreciating the property versus the standard deduction, which requires no add back of depreciation when you sell the house. You've got your cell phone use, 100% write-off. Let's see. Hopefully, everybody out there, and I've got some clients that are doing very well in the market right now. And I just sent an email off to a client this morning, and he said that this year he is up right now in 2023 versus what we thought where he thought we would be back in April of 2023. So I said, okay, fine, let me update your income projection, and based on that, we're gonna have him send a little bit more money to the IRS and to the state of Michigan as an estimated payment. So as individuals and filing tax returns, as you go throughout the year, and if you're going to have a profit, the IRS and the state of Michigan require that you make estimated tax payments on the balance that you're going to owe on April 15th, in this case, 2024 for your 2023 return. There's an estimated payment due April, due June, due September, and due January of the new year. Okay? You normally pay a quarter each quarter. Okay? All right. Questions? Thoughts? Anybody out in the audience I can see? Yes, sir.
Take advantage of not having to match the Medicare Social Security. You have to set up an LLC.
No.
So the question here is?
So the question would be, I guess, as I'm getting at, I'm going back to, you're talking about if you're paying a child?
Straight up, individual on my tax return, I have to match that half.
Oh, okay. So yes, as a sole proprietor, and this is again why I tell clients, it's like, look, you want to get your bottom line profit down as much as you possibly can because you're paying income tax on that profit, and you're also paying self-employment tax on that profit, which is the 15.3%, which again, if I'm an employee, my employer takes out 7.65%, and they're required to pay 6.5% on my behalf. You, as a sole proprietor, get to pay the whole 15.3%. You get a deduction on your return for half of that, but you still have to take out of your pocket the whole 15.3. Okay?
So my question is that if you formed an LLC, does that alleviate that?
Doesn't change anything.
Oh, so this
Yeah,
is
no.
actually a good question because it brings up a couple of things. So the question here, guys, was if I formed an LLC, is there a benefit to that?
No, there's not.
Okay,
No.
so that's the simple question. But remember, the other thing for us in real estate is, guys, think about who's the only entity that a broker can compensate with commission. It's a real estate licensee. So we have to hold the license. The reality is our broker can only pay licensees. We cannot compensate unlicensed individuals for what we do. So we can't, if you did form an LLC, somehow you'd have to get paid by the broker and take that money into an LLC, but that's what a CPA is going to tell us to do.
The LLC is, from that perspective, Darwin, the LLC is essentially you.
Yep.
I think what we're talking about may be a little different, and I'm not sure if you're digging a little bit deeper, the difference between an LLC and an S corp.
I was under the impression a couple of years ago that in order to form this LLC.
Larry, let me get you, Mike, so that everybody can hear this.
Broker's license or associate broker's license. In order to alleviate paying that 15% or that half.
Okay. Okay, so what you're referring to, as you just said, so if you set up an LLC and you create an LLC and then you elect to be taxed as a subchapter S corporation, okay, then you can pay yourself a salary for a piece of your profit, and then you can take distributions for the other piece of your profit. Okay, you can split your profit if you're an S corp. Whereas if you're just strictly an LLC, all of that money is subject to Medicare and Social Security tax.
Okay.
Is that what you're getting at?
Yeah.
Yeah, right. But you have to be an S corp. And number one, in order to be an S corp, you have to be a broker, because the broker can't pay, the broker that you work for can't pay an S corp if you're not a broker. So first you have to be a broker and then set up your S corp, and then the broker that you work for can pay your S corp.
Okay.
Otherwise, we have to do kind of an end around run. It's doable. We don't do a lot of it, but it is workable.
Is it worthwhile to do that?
Well, that's another question, okay? Because if you set up the S corp, now you've got to have payroll. So that means either you're doing the payroll or I'm doing the payroll, or you pay for a payroll service, which is going to run you roughly somewhere between $500 and $1,500 a year. That's your payroll service. Then if you're an S corp, now you have to pay me to do an extra tax return. I'm loving that because I've got extra work to do. But that means that's extra cost out of your pocket. So first we have to do the bookkeeping, the accounting for the S corp, which that's going to run you somewhere between $800 and $1,200. And then you have to do the tax return for the S corp, and that's going to run you another $800 to $1,200. Okay, so now if you look at it, just make it real simple. $1,000 in payroll cost, $1,000 for the bookkeeping for the S corp, and plus $1,000 for the S corp return. You're looking at $3,000.
And don't forget about the brokerage license.
Okay.
Because you got to have that.
Yep.
Plus you're still holding your more likely associate broker's license to be with
Right.
Century 21 or Coldwell
Right.
Banker.
So there is a point where that does make sense to be an S corp. But in the place where that makes sense is if you're a very high producing agent, and I would say you're going to have a gross of $200,000 or more in commissions on an annual basis. That's when it would make sense. Because then I can say, okay, fine, if you've got a net bottom line, say your bottom line profit is 130 grand. So now I can say, okay, fine, take that 130, split it into two, pay yourself 65 on a salary, and then the other 65, you're just going to take as draws, and there's no 15.3% on that 65,000. Okay? That's where it makes sense.
So there was a question here that at closings on real estate, a seller is asked a question as to whether or not they ever used the home to produce income. So do home offices count as producing income in your private home?
Yes, they do. Yes, they do.
Oh, boy.
Yeah, you can't get around that one.
So there's the simple answer.
Yeah.
And then also deductions for items paid for clients. So a common one is we have what we call the broker compliance fee. And occasionally, the fee doesn't go away,
Right.
but occasionally as a agent will pay that on behalf of the buyer or the seller.
Yep.
So home warranties, so on, are those something that are deductible?
All of that is anything, think of it this way, anything that you need to reasonably run your business, anything that you need to reasonably do to earn the commission that you are going to earn is a deductible expense. Any warranty claims that you might cover, any warranty costs, any warranties that you might buy to put on the house that you are selling. If you bought a home warranty, any, broker fees that you're paying, anything along that line is all deductible because it's what the IRS calls ordinary and necessary for you to run your business. Car payment, well, that gets back to auto expenses. Okay, so when you have a car payment, you've got the interest cost and you got the principal. So the interest can be a deduction. Yes, the interest you can write off, and then you depreciate the car, which the depreciation on the car mirrors somewhat of the principal part of the payment that you're paying. Okay, and that's if you're using the actual expenses for the car versus standard deduction.
So here then is a, quote unquote, what we call closing gifts. Deductible?
Gifts, we talked about this before. Gifts are deductible to the tune of $25 per gift. That's it. Can't buy much for 25 bucks.
That's right.
You could buy them a $25 gift card. Not going to go very far. But, and we've talked about this also, and I promote this, and I've done this myself. If you were to buy something or give your customer something that has your name on it, if it's branded, and the one thing that I use the most, and we see him at all types of various different seminars and conferences that we go to, we have Luke from Cutco.
Yeah.
If you were to buy a set of Cutco knives or some select knives and present them to your customer and they have your name on it, Darwin Conley, real estate professional, that is more of a promotional product than a gift because it's got Darwin Conley on it.
And it will go under that category as
Correct.
the deduction also.
Correct.
So then on that same flavor, I'm thinking, if we were to offer, here's one, resort vacation certificates. Oh, you've heard of that one.
Yes.
And so if that was part of marketing that when you list, we give you this, is that a deductible? Is it promotional? Is it pushing the line? Should you do that?
That one's pushing the line. Should you do that?
Okay.
Because at least I don't think you have any way to brand it. I mean, you don't have any way to say this is Darwin Conley's resort.
It might. Well, so if it was branded, that's where,
right.
because of our parent company, the relationship with, it may have Coldwell Banker on it or a Century 21 on it, but that would be the key.
Right, that would be the key. If it's branded, yes, it's got to be branded. It can't be just, you're going to just go off to the U.S. Virgin Islands on St. Thomas for a week, free. That's not going to fly.
Gotcha.
Yeah.
Gotcha.
Okay. What
All
else do we
right,
have
so
here?
let's see, what about if an agent pays cover, so there's the vacations, showings, et cetera. So if we compensate, common for a busier agent, I might say, hey, Dirk, can you do me a favor and go out and show these homes, and I pay him, $50. Is that deductible?
Sure.
If, how much do
Now, he's going to have to get a 1099 if you pay him over $600.
So up until $600, I can write that off.
That's right.
I just need to document it.
That's right. Yep. Okay, the question I think that we have is, what about if we pay an agent to cover for vacation showings, et cetera? Okay,
Yeah,
that's
so
what
that
we're
was
talking about that. Okay.
Yep.
I was thinking a little bit different, but okay. But let me expand on that then a little bit, because and the IRS loves people that go to Florida in February and March. They love it because they're saying, I'm going there for business, but they want to know that it's business. They want you to prove that it's business because they know that we love to go to Florida in February and March, maybe even January, February, March, and maybe even April. So you have to make the business purpose for your trip to Florida. And you can say, well, okay, fine. I'm going to go show houses, or I'm going to make some calls on some various brokers down in Florida. That can work, but you're on the fringe. If you're going to do some things in Florida while you're there, you really need to set some appointments and set your schedule and set some things up before you leave. Now, how are they going to find that out? I'm not sure about that. But the rules and regulations say, if you want to play by the rules and regs, that you need to set your schedule for who you're going to see and where you're going to go and what appointments you're going to have while you're in Florida. You need to set those up before you go. But it can be, that can make some of your Florida trip deductible. Just like if you had a Caldwell Banker conference or a Century 21 conference or whatever conference you might have around the country, the cost for that are all deductible. The hotel, the plane ticket, whatever costs you have for that conference, wherever it might be, is going to all be deductible. 50% of the meals are deductible. And you could do that if you made your trip to Florida. But again, you have to make sure that you set it up before you leave.
And so I'm sitting back and thinking, if I take a few extra days, are those days included, such as the hotel and the meals?
No, they're not.
So my flights would be fine.
Right. The flight doesn't matter because you're paying, you're going out and
You're-
coming back no matter what.
So probably the best that I'm going to do is maybe the day before or the day after I could include for hotel and meals.
Yeah. Right.
All right.
Yeah.
That's a good one. And
So if you have a 3-day conference, you can make it a 5-day conference
Mhm.
or maybe even a 6, depending on in and out time.
Right.
Okay.
Right.
You could work it a little bit.
So shifting gears, Steve, I think you're talking about the broker compliance fee. You put TMF. So if I go back to that, typically that's a fee that's charged to a buyer and to the our sellers.
Mhm.
But as an agent, we will pay them for them. What's the best way for us to track when we as agents are paying that fee? We're paying it directly to the company on behalf of a buyer or on behalf of a seller.
What's the best way to track it?
Would it be just write a check
Yes. Yep.
and then make a statement that this
Mhm.
is
Yep.
broker compliance fee for the
Correct.
property?
Yep.
Um,
And then from there, hold on one quick
Yeah.
minute. So then from there, if you are, again, as I talked about earlier, as Darwin just said, if you're writing a check or you're charging it on a credit card, from there, you want to take the checks and enter that information into some software. You want to use Wave, or you want to use Zoho Books, or you might want to use QuickBooks, whatever you might want to use. If you enter that listing or enter all the expenses that you pay for during the year, you writing a check, or all the expenses that you pay for on a credit card, you now at the end of the year, you have everything already categorized and ready to go, and you can make sure that you've got everything covered. You reconcile your bank, you reconcile your credit card, make sure that everything that you've spent is recorded, and then that QuickBooks file or Zoho report or Wave report goes to your accountant or CPA at the end of the year so that they have information to prepare your tax return.
Now, should we do it as a reimbursement to the client, or should we pay it directly to the company on their behalf? What would be best from that direction?
I would pay it directly to the company on their behalf.
Okay.
That's what I would do with it.
All right.
Because again, the IRS, if you're writing checks to somebody, the IRS wants to know who you're writing checks to. And if you're writing a check back to, in this case, the company, then it's like, okay, fine, this is what this is for. And they know that it's going back to, and they can see it's going back to the company. So there's not a problem there. It's just like, broker fee or MLS fees and things like that. You've got it going to directly to a named company that the IRS will be.
Yeah, because otherwise, if we were reimbursing a client,
Mhm.
we're basically going to have to end up pulling out a closing statement that shows that it was charged and we reimbursed
Right.
them.
Yeah. And then you get into issues of, is it over $600? Is it not over $600? Did you write them more than one check? And then you got a 1099 issue now.
Well, so here's another. Yes, it will have our name or agent's name as a gift. John, I'm not sure what you meant by that. You might have to expand on that one.
Well, that does make it a deductible animal, though. But at that point in time, again, John, I wouldn't call it a gift. I would call it a promotional item if it's got your name on it.
And I think we're
Or your
going back to
agent's
the,
name
maybe
on-
the broker compliance fee, but whatever the gift is, as long as it has our name, our brand on it,
Right.
it's promotional.
Correct.
And no longer, we'll do the quote unquote gift.
Right. No longer a gift. Right. Yeah. Yep.
Okay, so then we got, does my kid who is 17 years old and below is my employee need to file taxes?
Yes, they do. Yes, they do. Because, I mean, if you're paying them, and I'm gathering that you're paying them, then the money that you are deducting, that's got to go somewhere because you've got a write-off. The IRS wants to see when there's a write-off and expense, they want to see that it's going to somewhere, somebody that's going to pay tax on it. So if you've got it going to your child, you file the child's return, you put the 13 grand on it, you got the standard deduction of 13 and it zeroes itself out and you're done. You're going to get caught on state of Michigan tax, but at least you've satisfied the IRS in being compliant in that regard.
Yeah, yeah.
Mm-hmm.
So this broker compliance fee, when it comes under tax categories, what would we put that under when we pay those?
I just put it under broker fees, is what I would do.
So additional fees?
Yeah. Mm-hmm.
Because the biggest key is that it's in there and you can justify it if you're ever audited.
Mm-hmm. Correct. Yeah.
All right.
Yep. Mm-hmm.
Then that's the last one that we got. That was for the vacation certificates that we were talking
Okay.
about. So those are branded
Got it. Yep.
when they come to us. So as long as we're putting them into a promotional
Mhm.
aspect, can explain that, then we'd be okay.
Right. Correct. Yes.
I think we're caught up on all those questions.
Okay. All right. Okay, good. Okay, so you're making, you have a profit, you're making estimated tax payments, you're covered from a perspective of paying the IRS. You're not going to get yourself caught into a situation where you get to the end of the year and you've spent all your commission money and you don't have any way to pay taxes if you make your estimated payments as you go throughout the year. Very important.
So having been one of those that when he started 36 years ago, just went, man, this is great. I had all this money and then I got the proverbial caught with my pants down and owed the IRS a whole lot of money. So if you're new in this business, we have to make these quarterly tax payments. When you get your commission check, we should hold a certain percentage out of that. My recommendation is always into a separate account at the bank so that I can make these quarterlies.
Correct. Yeah, Darwin, yes, that's correct. I mean, so if you mentally think about the fact that I've got a commission check here, I've got $5,000 I just got on the sale of this property, and I've got $5,000 in my pocket, you've got to think about, I don't have $5,000. I've got $3,000 because $2,000 I'm going to put in my account for taxes. Because I'm going to have to pay that out. Because I remember I got to pay income tax, which is going to be somewhere between 12 to 22%. Then you got 15.3% on self-employment tax. So you got to keep all that in mind. So you get a $5,000 commission check, $3,000 you can spend, $2,000 you should save. Federal tax and state tax.
So, I always tell everybody as a new agent, unless if you're really going to kick tail and take numbers, you better take at least 20% and set it aside.
Right.
But 30 is a really good number, isn't it?
30 is I like the number 30 because you get enough to put away for federal, state, and you have some money left over to put money into a retirement account.
Yeah, and Renee, what you need to do is just tag the one picture because I can't get things set up right with my camera, so I apologize that. So if you want to see Kevin as he's talking, you need to just what's the word, pin his picture in there, and that way you'll be able to see him as he's got that. But my apologies, it was a little bit hectic this morning. All right.
Anyway, so yeah, 20%, 30%, save that out of your commission check. 20% will be enough normally to cover your estimated taxes. And then I like to add a little bit extra to cover your retirement account if you want to put money away in a retirement account, which I highly suggest. And at that point too, you may have a little bit extra left over to cover your first quarter estimate that's due in the next April. You got to remember that.
Yeah, I found it to be really great because all of a sudden there's this extra money. And it's just a nice, comfortable feeling to know that you have that. And of course, again, what you brought up, maybe it's because you've got that, set it aside, put it into the IRA.
Correct. Yep. Exactly.
Great idea.
Yep.
Great idea.
Yep. Okay. Any other questions out there? I don't see
I think
anything
that's
yet.
it.
Okay. All right. So we've talked about car, we talked about home office. you've got cell phone, you've got your normal expenses, what the IRS considers to be ordinary and necessary, which, can be some things that I wouldn't normally think of, but some people might have something a little bit different. So again, it's keeping track of your expenses, credit card, check, writing it out, putting it in software at the end of the year. If you use some type of a software, that will give you some history over the years also. I set up my company back in 2006. I've been using QuickBooks since 2006. I've got all that data on QuickBooks, and I can go back and look and see what my numbers were, what my percentages are. I'm up, down, where my numbers come in, and I've got all that history than just writing it out on a piece of paper and handing it to somebody. You can see where you've been. Are your expenses up this year versus last year? Are they down? Where are your expenses? At least get some kind of an idea.
Awesome.
Okay.
Awesome.
All right. There are some things I'd like to talk about that are brand new for 2023. Some new ideas that are coming that have been out by the IRS. One of the things that is important that I think about, and it's in we'll go back to the PowerPoint presentation at this point. So in 21 and 22, the child tax credit, the child tax credit was increased to $3,000 per child, $3,600 if you had a child that was 6 or under, I think. Those numbers have dropped back. It's $2,000 per child for 2023. You've got the child and dependent care credit, which you can put $5,000 into an account if you have an account set up through your employer. Also, if you want to, in addition to putting money away into a retirement account, into a SEP plan, IRA, if you have a high deductible health insurance plan, you can put money into a health savings account we're talking about here. They're a great planning tool. The money can sit in the HSA. It can sit there until you use it. It doesn't have to be used this year or next year. It can sit there until you use it. And if it doesn't get used, you can then take it out as income later on down the road. Okay. Traditional IRAs are also a great scenario. What do I got here? It might have gone to sleep on.
Let's see.
There we go.
There you go.
Okay. All right. So another thing, gifts to family members. Every once in a while, I get a question about giving a gift to a family member. A gift to a family member is not a taxable event to them. It's not a taxable, it's not a deduction to you. It's just a gift. You can gift up to $17,000 in 2023, $18,000 in 2024. And if you want to give more than that, or if for some reason you need to give more than that, every person every taxpayer has a $2.9 million once lifetime exclusion. So if you give a gift that's $50,000 to someone, you can just file a gift tax return and reduce that 2.9 million once in a lifetime exclusion. Okay. 1099K, 1099Ks. So the IRS is cracking down on, filing 1099s. I've gotten calls from clients that maybe they have a child that's doing an Etsy business or an eBay business, and maybe they would earn, a few $1,000, $5,000, $6,000. And are they going to get a 1099 from eBay or from, I can't think of the other companies that would pay you, PayPal. You might get a 1099 from PayPal. So they've backed off on that for 2023 and are looking more to picking that up in 2024. Everybody's probably heard about the employee retention credit. Employee retention credit, be careful with that. If you have employees, this might not apply to anybody in this on this call, on this Zoom, because if you're not an S Corp, you're not paying wages, and the ERC employee retention credit wouldn't apply to you. But if you've heard about it out there, the IRS stopped processing employee retention credit claims, and there was just a lot of blatant things going on that they said there's too much going on and we're just going to stop it. If you deduct mileage on your vehicle, make sure you take an odometer reading in the next couple of weeks. Let's see, planning idea, take your child. Okay, we're talking about child out for business. We already talked about that. Okay, this is the big thing for 2023. At least I see it as a big thing. There's always, I shouldn't say always, the last 15 years, there's been a home energy credit available. When the home energy credit first came out, it was $500 15 years ago. Then it went from $500 to $1,500, and then it dropped back to $500. And it was a one-time, if you took the credit and you were at $500, it was all done and it was over. For 2023, there's a brand new energy credit out there. As you can see, if you look on the slide, the maximum credit is $1,200 for 2023, and it's for energy efficient home improvements, similar to the things that you would find in the past, a furnace, a hot water heater, windows, insulation, things along that line. Whereas before you were limited to $500 total, now it's $1,200 per year. Okay, so that's a big thing that, as far as I see, for taxpayers wanting to do some home improvements, get some things, and get some money back from the federal government. There's also some credits out there for contractors. All right. Let's see, commercial buildings. Okay, talk about that. Energy credit deduction continued, nothing there. Gifts to charity. Okay, so if you're itemizing, great. It may be more difficult for you to itemize at this point in time. If you're married filing a joint return, the standard deductions $27,000 plus. So you've got to have charitable contributions, taxes, which you're limited to at $10,000, and then mortgage interest, you've got to have over $27,000, which might be difficult to get there. But if you are so inclined to gift to charity and that gets you over the standard deduction, that's a great thing, and that will get you more of a write-off if you're doing that. There's also out there, again, if you, depending on if you're your income is large, there's what's called a donor advised fund out there. You can put money into a donor advised fund, take the deductions as charitable contribution. You can put away up to $100,000 per year, and then you can gift that money out from the donor advised fund as you go. It doesn't have to all go out. Okay. Okay. Also too, I'm sure that there are agents that you have that are still working that are over 72.
Yeah,
or
there's a
73,
couple of them.
a few here and there. So if you are in the age where you have to take a required minimum distribution, instead of, when you take a required minimum distribution, you're taking money into your income and paying more tax. If you have a desire to gift to a charity, instead of taking the money out and paying tax on it and then giving it to a charity, you can have your company that holds your IRA gift it directly to the charity, and that's not income to you. You don't get a charitable deduction for it, but it's not income to you. Okay. Educator expenses still deductible. We know that. The $250 if you're a teacher, if you spend money on educating children. Retirement plan. Okay, retirement plan options, as I talked about earlier. There's a simple plan. We have a simple plan in our office. A SEP plan would be for individuals, so proprietors. A solo K at the very bottom there, what we talked about for solo K retirement plans. Let's see, 2024 information. Nothing that's anything that we need to deal with right now. If you want to look at what is coming in January, rates are going to still stay the same in 23 as in 24. Brackets are indexed for inflation, so the brackets go up. Top tax bracket, 37%, doesn't start until $71,200 per joint tax return. Okay. C Corp rates, 21%. Capital gains rates, still 15%. No law change income over 600,000. Estate tax changes, nothing there that needs to be dealt with. IRA, okay, good. Capital gains and sale of house. We talked about sale of house cap gains. Talked about that. 2 out of 5 years, you own your home. It's your principal residence. No tax. 250,000 single. $500,000 joint filing tax return. All right. State of Michigan, flow through payments. That's a scenario if you have an S corp. Not if you're a single member LLC. That's not going to apply to you. For 2023, one great thing that's out there, you're going to pay 0.20% less. The state of Michigan tax rate drops from 4.25 to 4.05 for 2023. Okay. Also, if you have a retirement plan and you have employees, if you set up a retirement plan, there's a brand new credit, $500 for setting up a retirement plan. And there's also $500 if you have a specific, the IRS wants people to be enrolled in retirement plans. So if you have your retirement plan set up and you have an automatic enrollment that everybody that's an employee is automatically enrolled in the plan, it's an additional $500 credit. Okay. Okay. Start planning now for next year's return, or, finish up what you're doing for this year. Review your paycheck. look at your net profit, whatever it might be, whether you have a spouse that's an employee and you have a net profit on your Schedule C, take a look at that, take a look at where you are, look at what you've paid in federal withholding, state withholding, and estimated tax payments. Organize your record keeping for me or forever, whoever your tax preparer might be. It makes it easier for them. Get into them early. It makes it easier for that. If you have not, and I would really urge everybody, if you have not talked to any type of an estate planning attorney, have a will, set up a trust, do something. So at some point in time, when you should pass on the assets that you have, there is a direction for where they should go.
That makes sense.
I've been, around for a while, and I've seen people pass away in their 30s and their 40s. And when you at least think of it, we always think about, we're going to live until we're 85. Well, we don't always all live till that point. And if it just comes up and it catches you from behind, if you don't have a will or a trust, it's going to be not a good thing. So everybody needs to set up a will or a trust. From that perspective, great. Check with your insurance plan, might do that too. Make sure you've got some insurance covered. I've been through a situation years ago when for a short time period, I sold cars, and I didn't understand why there was life insurance when you bought a car.
Mm-hmm.
And then I had a gentleman that I sold cars with. He sold a car to a couple. 6 months later, one of them passed away, paid the car off, and they were all set. And I thought, well, okay, fine. That made sense to have the life insurance at that point. So just a thought. Any other questions you might want to post up? I'm here to answer whatever questions you might have. We have a website. We have an email address on our website. If you send a question out there, I can check on that. Thank you very much. That's what I have, unless Darwin's got something else.
There's one on the home energy there.
Does the home energy efficiency deduction apply to rental properties? No, it does not. I looked at that this morning. It does not apply to rental properties. It applies to a second residence. It applies if you are renting the property, but it doesn't apply to the landlord. So if I have a rental property, I can't take an energy credit for my rental properties, but you as a renter, if you spend money to improve the renter, improve the property that you're in, that could be deduction for you. A lot of fees. All right. Any other questions? Thank you.
So guys, I'm on the side here, but there's Kevin and Kevin's book. If you would like this, I think at this point, just advise your manager that you would like a copy of that, and we will make sure that it gets to the manager for distribution directly to you. Hopefully you've already written down Kevin's information here for the website, that you've got the phone number. These are guys that, again, you've got those in the office that specialize that working with real estate agents.
Correct.
So
Right,
these
correct.
guys know what they're doing to be able to take care of us. So if
Yep.
you don't have one, great people to be able to check in with and
Yep.
call. So
Yep.
with that, I'll jump on camera and give a thank
right.
you. Guys, this is the last Tuesday that we're together for the year. So I hope you enjoyed it, and keep working, keep talking to people. You're setting up for 2025, and that's what today's or 2024. I'm getting way ahead of myself. You guys take care. Kevin, thanks again.
Thank you very much. Appreciate it.
See y'all.
Take care.
Bye.
All right. Good deal.
Yeah, let me
Awesome.
get us
They're
all
still
set
hearing us
off
up, yeah.
here.
All right. Good deal. Oop, oh, I'm on the mic still.
And
Thank you.